Ever feel like logging into your investment account is like strapping into a terrifying amusement park ride you didn't actually sign up for? You watch the numbers flash on your screen, feeling that sudden knot of pure anxiety in your stomach as markets flip-flop. Welcome to the classic financial playground, where your wealth-building journey is governed by a strict, unavoidable law of nature: the risk and return trade-off. Think of your hard-earned money sitting on a giant playground seesaw, where you are constantly trying to balance two completely opposite forces to stay steady. On the left side, we have stocks, which we can visualize as a high-energy, fiery rocket booster that promises to shoot your net worth into the stratosphere, but is prone to chaotic, unpredictable loops. Financial pros call this wild, stomach-churning ride volatility. And if you lean entirely into it, your portfolio could crash into total ruin before you ever reach retirement.
Let's take a closer look at that roaring rocket side of our seesaw to understand why it exerts such a powerful gravitational pull on casual investors. When you purchase a stock, you are buying a tiny, literal slice of ownership in a real-world operating business. If that company expands its operations, innovates brilliant new products, or dominates its global industry, the value of your tiny slice blasts straight upward. This thrilling climb represents the pursuit of high returns, allowing your capital to compound over time significantly faster than the eroding effects of inflation. But rockets require highly volatile, explosive fuel to achieve liftoff. When bad economic headlines drop or consumer trends shift overnight, that rocket can plunge toward the earth without any warning. This intense, unpredictable shaking is the literal price of admission for long-term equity growth. You simply cannot enjoy the spectacular market highs without surviving the turbulent, stressful drops along your timeline. Now, let's jog over to the completely opposite side of our playground seesaw, where the environment feels beautifully quiet and serene. Here rests a massive, unmoving concrete anchor representing bonds. When you buy a bond, you aren't an owner. You are actually a lender. You are extending a structured loan to a government or a large corporation, and in exchange, they legally promise to pay you back with regular interest payments, known as your yield. This highly predictable, reliable stream of incoming cash is what the financial world calls fixed income. Because these established institutions are legally bound to repay their debts, this concrete anchor rarely shifts an inch, providing ultimate stability during historical economic storms. When the stock market rocket goes spinning totally upside down, this heavy anchor stays firmly rooted to the solid ground, protecting your core principal balance from sudden, devastating loss, though it won't ever fly high into the clouds. This brings us directly to the incredible magic of how these two completely opposing forces interact on our financial seesaw. Historically, stocks and bonds often exhibit an inverse relationship, meaning they move in opposite directions to act as a natural, built-in counterbalance for your net worth. When the global economy is booming and optimism runs sky high, eager investors flock to the stock rocket, causing it to soar while leaving the quiet bond anchor sitting completely ignored on the grass. But when an unexpected recession hits and panic sweeps through Wall Street, terrified investors flee the chaotic rocket and pile their capital into the safe, comforting embrace of stable bonds. This perpetual shifting of weight is what keeps your playground seesaw from completely flipping upside down. By holding both asset classes simultaneously, when your high-flying stock rocket takes a sudden, scary dive, your steady concrete anchor prevents your entire life savings from crashing painfully down. So, how do you personally decide exactly where to sit on this financial seesaw? This critical strategic decision is called asset allocation, and it must be tailored entirely to your unique life goals and investment timeline. If you are decades away from retirement, you can easily afford to pile massive weight onto the stock rocket because you have plenty of years to recover from any sudden temporary market drops. But if you need your money very soon to buy a house, fund an education, or retire comfortably, you must intentionally shift your weight toward that steady bond anchor to protect your hard-earned nest egg. Finding your perfect playground equilibrium means matching the seesaw directly to your personal risk tolerance. You want just enough rocket fuel to grow your wealth over time, but enough solid anchor weight to ensure you can sleep peacefully through the night without experiencing any painful, unnecessary overnight financial market anxiety.
Here is the final, crucial secret to mastering your financial seesaw. It will never stay balanced on its own. Over time, a roaring, highly successful stock market will cause your rocket side to grow exponentially heavier, tilting your entire portfolio dangerously out of alignment without you even realizing it. If you do absolutely nothing, your asset mix becomes accidentally risky, exposing you to massive potential losses when the market eventually cycles. That is precisely why smart investors practice a routine playground tune-up known as rebalancing. Periodically, you intentionally lock in profits from your overgrown rocket side and systematically reinvest them directly back into your steady concrete anchor. This highly disciplined habit forces you to execute exactly what Wall Street pros preach: selling high and buying low. By actively managing your allocation, you maintain total control, ensuring your seesaw stays perfectly tuned to build lasting wealth safely, confidently, and predictably for your long-term future goals.
As always, appreciate you hanging out today. See you in the next one.